Hey! Hi guys, and welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, veteran stock markets trader and analyst at Cointelegraph. Today's show will start by discussing Germany, Europe's largest economy. The Wall Street Journal headline looks worrisome. Germany is dragging down Europe's economy. The article starts by explaining that Europe's largest nation and its main growth engine has become the biggest drag on its economy. At the heart of Germany's weakness is the high reliance of manufacturing, a feature of its economy that many Western governments are now trying to replicate. Okay, that makes sense. In theory, during recession environments, it is natural for governments to stimulate domestic production by creating artificial benefits that usually makes imports more expensive. Simply raising the import tax could cause retaliation, so those countries usually recur either to long-term subsidized financing for the domestic industries or subsidize the energy. It's the same. There's little doubt that Germany is Europe's biggest economy, as its gross domestic product, or GDP, ranks number 4 globally, some 42% ahead of the second position, France. Moreover, manufacturing is responsible for nearly 20% of Germany's economy, meaning the defensive play by foreign nations, so the subsidies, or even a global GDP contraction, has severe effects in Germany. To put things in perspective, Germany exports $1.6 trillion per year, which is a mere 20% behind USA. To make things worse, the manufacturing industry in Germany entices 10% of the workforce. However, the country's exports have been declining for the past 7 years, causing the surplus, which is calculated by export minus imports, to reach the lowest level in 23 years. So now Germany has a big problem at hand, because a less favorable trade balance, sided with an estimate 0.5 GDP decline in 2023, will cause the government to have less money available to pay for its costs, including pension funds and public workers. The article adds, German factories built up a huge backlog of unfilled orders during the pandemic supply disruptions. Working through those orders will keep many busy for some time, but new orders have been falling since the start of last year. So here you have the chart of the diminishing demand. So you can see that the total factory orders were positive, so above 100% meaning positive, and it's now below 100%, so declining year over year. Wait, there's more. Berlin has offered energy subsidies to keep its factories running until they have access to expanded and less costly renewable energy sources. So never. That's unbelievable. But you've got to remember that countries outside of the United States have strong unions, so the cost of letting go thousands of employees is very high. So there are incentives to keep the lights open even when operating at a loss. The author then adds, a sharp rise in energy prices last year made producing goods more expensive. And with inflation and interest rates going up around the world, foreign consumers can always afford the higher price tags. You don't say. Okay, so there's a clear problem going in the world's 4th largest economy. But what does that have to do with cryptocurrencies? Simple. Do you have any idea what is the world's largest fiat money? I give you a hint. It's not the USD dollar, nor China's yuan. Yes, you got it right. The euro, partially because it encompasses more than 20 countries. The euro was officially launched 21 years ago versus Bitcoin 14 years ago. That's how experimental the euro currency is. So those betting on the fall of the North American empire and the US dollar dominance may have picked the wrong victim. Odds are, if Germany's GDP continues to fall, the Euro Central Bank ECB will also suffer to hold the region's yield at a sustainable level, because if there's no demand for European bonds, the yield goes up. So the next time the government has to issue bonds, they're gonna have to pay higher yields. So that's bad for their economies. That's increased interest rates payment. Does that mean that the euro currency is doomed? For now, it seems premature to assume that, but there's a good chance that it will succumb ahead of the US dollar, so before of the US dollar. Ultimately, the Europe and the euro going down, especially if Germany's economies continue to contract, is good for Bitcoin in the mid to long term. Now, let's move to Asia, the country that continuously surprises me the most. Bank of Japan sends yield soaring with surprise change to rate limits. Some market players remain unconvinced. A pledge by the central bank to buy 10-year government debt at 1% each day instead of 0.5% would suggest a new line in the sand at 1%, a level that would mean an effective doubling of the movement range. So, what happened here? Well, the Bank of Japan is trying to convince the markets that it's not raising interest rates, but they're effectively paying up to 1% per year, up from 0.5%, out on the open markets, so in the secondary markets. So basically, yes, they have just raised the interest rates. Okay, but who cares for Japan? Their economy has been stagnant for more than 20 years, and their debt ratio has been above 200% of the GDP since 2010. It's basically a dead man walking, which has forced the government to be the largest owner of stocks and corporate debt in the region. Yes, you heard it right. The government is the biggest holder of stocks and bonds in the country. There's no ultimate buyer for that. Well, the Bloomberg article answers that question. The Bank of Japan is a closely watched driver of markets around the world, in part because Japan investors are major holders of US government bonds and own everything from Brazilian debt to European power stations. Okay, so now things get interesting. The rest of the world is concerned that Japan will have to offload their holdings in bonds, stocks, and other assets, which would have significant negative impact during a pre-recession environment, so likely causing a crash on those markets. So what's the biggest stake here? Well, how the global economies are closely tied. That becomes evident when you realize that China and Japan combined hold $2 trillion worth of the US treasuries. If those countries decide to dump their holdings, it might cause a huge turmoil in the global economies. There's simply no way Japan could go down without causing a huge impact on other regions. That's how the country is able to survive even as its debt over GDP ratio surpasses 260%. For Bitcoin holders, that's both good and bad. The negative side comes from the fact that the US will always gladly help those affected regions, just like it did during the banking crisis and the Euro Central Bank, the ECB. They created an agreement offering hundreds of billions of emergency funding and liquidity for the financial system. That was this year, 2023. On the bright side, at some point, the trust in this system will break, regardless of the trigger, of the reason. So, hang on tight, because the timing for those events is impossible to predict. There's just too many variables, and most depend on how investors trust or not the fiat system. Well, that's it for today. I hope you guys enjoyed the show. Remember to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. See you!